Dear viewers, everyone knows the sharks from Shark Tank, those business gurus who grill young founders on valuation, profits, and market sense. But here's a twist. One of those sharks is now in the tank himself. We are talking about Peyush Bansal, the founder of Lenskart, India's biggest eyewear retailer. And his company is about to launch one of the most talked about IPOs in recent years, worth a massive rupees 7,278 crore. But this IPO isn't making headlines just because it's big. It's because analysts believe the valuation might be way too high. And that's where the controversy begins. Hello, I'm Khatija and you're watching Lokmat Times. If you're considering investing in the Lenskart IPO, this video is for you. In this video, I'll break down what Lenskart's current valuation is and why it's controversial. Why do companies sometimes inflate their valuations and whether inflating valuation is illegal? But before we start, you know the drill. Please do subscribe to Lokmat Times if you haven't already and press the bell icon to never miss an update. On paper, Lenskart looks like a dream story. In fiscal year 2024 to 2025, the company jumped from rupees 10 crore loss the previous year to a rupees 297 crore profit on revenue of rupees 6,650 crore. That's a complete turnaround from red to black. But when analysts dug deeper, they found that this profit wasn't exactly from selling glasses or frames. It came from something called a fair value through profit or loss gain, or FVTPL gain worth rupees 167 crore. Basically, this profit came from revaluing an old deal, not from new business. A few years ago, Lenskart bought a Japanese eyewear company called Ondays Inc. Part of that deal involved some deferred payments, money to be paid later. Now, accounting rules say that if the estimated liability, that's the money you owe, goes down, you can record that as a profit. Even if you never actually got the cash, that's exactly what happened here. Lenskart reduced the value of what it had to pay Ondays, and that drop showed up as a gain in the books. In short, a paper profit, not an operational one. So what's the real picture? According to Abhinav Tiwari, research analyst at Bonanza Portfolio, if you remove this one-time gain, Lenskart's actual profit falls to around rupees 130 crore. That means its real net margin is just about 1.9%, far lower than what the headline number suggests. Now here's where it gets wild. At the upper IPO price of rupees 402 per share, the company's price to earning ratio shoots up to somewhere between 200 and 535 times. To put that in context, APE of 30 to 40 is normal for established brands, 70 is high for fast-growing retail, but 500 plus, that's tech startups territory. So investors are being asked to pay tech company prices for a retail business that sells glasses. The IPO papers reveal that Lenskart's promoters and early investors are selling shares worth rupees 1,100 crore under something called an offer for sale, that is OFS. Now, when founders sell a chunk of their own shares during the IPO, it often signals they are trying to cash in at a high price, rather than holding long-term for future growth. That doesn't automatically mean something shady, but it does make investors pause. Let's be fair, Lenskart isn't just hype. It's built one of the most successful retail networks in India. Over 2,500 stores nationwide, a 70% gross margin, a smart omni-channel model that blends online ordering with in-store fitting but profitably still looks thin. In June 2025, the company made rupees 61 crore profit on rupees 1,940 crore revenue, and even that included another 5.5 crore accounting gain. Without that, the net margin drops below 3%. Lenskart's total valuation is pegged around rupees 70,000 crore or $8 billion. That's huge, even by global standards. Now let's see how that compares. Lenskart is valued at more than 10 times its annual revenue, with a price to earnings ratio between 200 and 535 times, far above normal retail standards. Titan Eye Plus, its Indian competitor, is valued at about 3 to 4 times its revenue with a PE ratio of up to 70 times, which is much more reasonable. EssilorLuxottica, the world's largest eyewear company, trades at around 30 to 35 times its earnings, far lower than Lenskart's sky-high multiple. So yes, Lenskart's valuation is many times higher than both its Indian and global peers. That's why market experts are calling it optimistic, if not outright inflated. Abhishek Jain from Arihant Capital said it clearly, Lenskart has built a strong brand moat, but the future growth is already priced in. Meaning, investors are paying today for profits that might only exist years from now. When asked about the criticism, Peyush Bansal didn't flinch. He said, I am only justifying the value for the customer. Our job as entrepreneurs is to make spectacles more affordable, not to justify valuation. He also added that valuation is decided by advisors and institutional investors, not him. Backing him up, Jayashankar Venkataraman, MD of Kotak Mahindra Capital, said the valuation comes from serious analysis and investors' confidence, and that major domestic and foreign institutional investors are backing the IPO. So basically, the logic is, if big investors are in, retail investors should trust the process. But let's shift to an important question. Why do companies want high valuation anyway? There is a playbook for this. First, attracting investors. A high valuation makes the company look like the next big growth story. Second, brand prestige. The higher the valuation, the bigger the media buzz. Third, promoter gains. Early investor stakes skyrocket in value, at least on paper. Fourth, expansion power. A high-value company gets better leverage in acquisitions and not partnerships. So in short, high valuations are like glossy packaging. They make everything look better, and even when the content inside is average. So is the inflated valuation illegal? Not by itself, but if a company gives false or misleading financial data, it's a serious offense under the Indian Companies Act 2013. Section 34 terms misleading information in a prospectus as criminal liability. And Section 35 says investors can claim civil compensation if they lose money because of false data. So if the profit or asset figures are intentionally manipulated, both the company and its directors can face heavy fines or even jail. This isn't India's first valuation controversy. Shock Clues, once valued $1.1 billion in 2015, sold for just $70 million in 2019. WeWork dropped from $47 billion to under $8 billion before its IPO. Theranos was worth $9 billion before it collapsed in fraud charges. And Closer Home, Paytm's rupees 18,300 crore IPO saw a 40% crash in stock price right after listing, again due to overvaluation. So Lenskart is a strong brand, no doubt. Its business is real and its products work. But the numbers around this IPO sparkle a little too brightly. A chunk of profit comes from accounting tweaks, promoters are offloading shares, and the valuation looks stretched beyond retail logic. So if you are thinking of investing, look beyond the glossy frames and the Shark Tank fame. Ask yourselves, are you buying solid vision or just good optics? Because in finance, like in eyewear, clarity matters most.